Recently, the NFT market has experienced a decline, dropping from a monthly traded value of $2.8 billion during the bull run in August 2021 to a meager weekly volume of $80 million in July 2023. How did this happen? What happened to all that money? Well, that's what we'll be examining today. But let's start from the beginning. What are NFTs to begin with? NFTs, or non-fungible tokens, are digital assets that represent ownership or proof of authenticity of a unique item on the blockchain. These tokens gained significant popularity in 2021, with everyone wanting to buy one for themselves. Celebrities from various industries were fascinated, and it was the talk of the town. However, today, things have taken a sour turn. NFTs are slowly declining with a substantial reduction in liquidity. The demand has diminished, and many NFTs now remain in their creators' wallets without being traded. While some NFTs still retain value, they have experienced a sharp decline in their worth. Recently, some NFT projects have performed well, but they are still far from their previous heights. This raises the question: are NFTs slowly fading away, and what does the future hold for them? Today, we will delve extensively into how these NFTs came into existence, the NFT ecosystem, the extent of its decline over time, and what the future holds for NFTs. NFTs have been in space since 2014, and while they didn't gain a lot of traction then, they already existed. In 2017, Cryptocurrencies, a project by the Canadian gaming studio Dapper Labs, exploded in popularity, marking the beginning of the rise of NFTs. In 2018, one of these virtual pets was sold for 600 Ethereum, which was worth $170,000 at the time. The rarity and characteristics determined the price. After this sale, transactions on the Ethereum blockchain surged, leading to increased transaction volumes and higher gas prices. However, CryptoKitties didn't achieve this alone. CryptoPunks, one of the most popular NFT projects, created the first wave of PFP, profile picture, NFTs for collectors. Collectors could now use their NFTs as profile pictures or for various other applications. This project, created by Larva Labs, featured 10,000 unique hand-drawn pixel characters. Due to the effort put into creating each of these characters and their unique characteristics, the prices of these NFTs increased, along with their rarity. These NFTs were primarily acquired by the wealthiest individuals, including celebrities and early adopters. As pioneers, their prices continued to rise. Over time, celebrities and large corporations became interested in NFTs, and everyone wanted to own a rare piece, considering it a symbol of respect for holders. Moreover, certain NFTs granted access to exclusive circles where value was shared. One of the corporations that hopped on the NFT train was the U.S. National Basketball Association, the NBA. The association allowed fans to purchase and trade highlights of its basketball games as digital tokens. Given the NBA's prestige, this quickly gained momentum, and the NBA recorded $224 million in monthly sales and more. Following this, any media of significant value could be sold as an NFT. Digital artist Mike Winkelmann, also known as Beeple, sold one of his digital artworks for a whopping $69 million. The US rock band Kings of Leon also sold their album When You See Yourself as NFTs, and Jack Dorsey, who was Twitter's CEO at the time, sold an image of the first tweet he ever made on Twitter for $2.9 million. At this point, it became evident that any media file with value could be sold as an NFT. NFTs evolved, gaining liquidity as more people poured money into them, leading to their explosive growth. Now, the NFT ecosystem comprises various components. To create an NFT, you need to host it on a blockchain. NFTs are minted from this blockchain by various collectors who have been granted permission by the owner of the NFT project through a whitelist. To mint an NFT, collectors have to pay a minting fee, which then allows them to mint a unique piece of art. When NFTs were initially gaining traction, they were primarily hosted on the Ethereum blockchain. Today, NFTs are hosted on several blockchains, including Ethereum, Solana, Avalanche, Polygon, Tezos, Flow, and Blockchain. Through these blockchains, collectors can easily mint their rare art. But how are NFTs traded? Apart from being sent from one wallet to another for trading, NFTs are also traded in secondary marketplaces. Marketplaces like OpenSea function like physical markets but in a digital form. Here, NFTs are displayed with their prices and traded like goods displayed in a market. If you simply like an NFT, you can purchase it through OpenSea. As a seller, you receive the value of your NFT in your wallet. Thanks to these marketplaces, NFTs have become easily tradable without any hassle. In November 2021, OpenSea recorded $1.9 billion in trading volume, representing almost 95% of the total NFT trading volumes. Other secondary marketplaces include Nifty Gateway, Super Rare, Foundation, and many more. With so much promise shown in 2021, no one anticipated the decline of NFTs in 2023. Did the NFT gold rush end, or was the initial buzz over? Have people come to see that NFTs are no longer worth it, or what is wrong with them, you ask? Well, it is simply what it is. Now, it is a bear market, and most people have had to sell their NFTs for less money than they bought them, accepting the loss and avoiding the risk of losing their value entirely. You may not really understand how bad the situation has gotten until we show you the numbers. Out of 73,257 collections on blockchains, 95.6% of these have a market cap of zero. Yes, zero. All their liquidity gone, with nothing to show for their value or what they were worth in the past. For all the investors who thought to trade these NFTs, it is sad to say that their investments are gone for now. This is no surprise, as everyone who dabbles in NFTs clearly understands how volatile the market may be. For collectors who treasure art, this is not as concerning, but concerning nonetheless because it shows that despite its great art, their NFT may not hold any value. Now, what is the cause of this? It is simple. According to the laws of economics, the price of a commodity largely depends on demand and supply. If the supply is more than the demand, the price falls, and if the demand is more than the supply, the price rises. Recently, there have been a lot of NFTs created overnight. The work and effort dedicated toward creating an NFT have been greatly undermined. With this oversupply, the demand for NFTs dropped. NFT projects have flopped recently, and only a few projects have stayed above water. Even so, some showed great promise at the beginning, only to flop later. Now, investors clearly want to see something spectacular, something beyond art offering utility. No one is mainly fascinated by the idea of NFTs anymore. They want to see what the NFT offers and what value it has in the crypto world or even in the physical world. With most NFTs lacking in this aspect, most of them have gone to zero shortly after launch. No liquidity and no interest shown from the market. While some traders still scalp profits from these NFTs, it is at great risk. Apart from the high supply, recent scams and frauds in the NFT world have given cause for concern. Several wallets have been drained recently through fraudulent mint links. Hackers recently hijacked Ethereum founder Vitalik Buterin's X account. Using this account, the hackers posted a phishing link that helped them take control of people's wallets. According to blockchain analysis, almost $691,000 were stolen from people's wallets, with 73% of it in NFTs. Although the link has since been deleted, the damage had been done, and some people had lost most of their assets to that incident. Popular rug pull survivor 𝐀𝐁𝐎𝐔 on X reports that over the last 4 months, several people have lost $13.3 million due to SIM swaps. Additionally, various crypto influencers have been accused of promoting rug pull projects. One of these influencers is the rapper turned crypto enthusiast Soulja Boy, who has used his social media platform to endorse NFT projects that have been revealed as scams. According to 𝐀𝐁𝐴CH, it is estimated that Soulja Boy has earned nearly $730,000 from promoting these profit-driven projects. 𝐀𝐁𝐴CH also tweeted about the Boneheads rug pull. This project raised over $3.1 million and then disappeared. The team proceeded to spend the proceeds from the rug pull on BAYCs, luxury goods, and other items. Another project, Pixelmon, raised over $70 million in mint funds after charging 3 Ethereum per mint. The team collected all these funds only to reveal an artwork that was poorly received. The art turned out to be subpar. and it became evident that the project was simply a rug pull. Many investors were unable to recover their investments and were left with worthless NFTs. Anemon, yet another project, also turned out to be a rug pull. The 9999 collection was advertised as a play-to-earn P2E game, claiming to offer utilities such as giveaways and trips. At a mint price of 0.2 Ethereum, investors purchased this NFT hoping to receive the promised benefits. It has now been months, and nobody has received anything. This NFT was promoted by influencer Jake Paul, who has been associated with NFT rug pulls. In addition to these rug pulls, the recent decline in the value of cryptocurrencies has also impacted the NFT market. Liquidity has become scarce, and most people are only willing to provide liquidity for the projects they have high confidence in. Now, amidst these challenges, what does the future hold for NFTs? With the issue of value, the future of NFTs still hangs in the balance. When we examine the top 8,850 NFT collections on CoinMarketCap, it's astounding to discover that 18% of these collections have a zero floor price, indicating no ongoing trades. Apart from this 18%, most of these NFTs are priced between $5 and $100. As for those at the top with prices exceeding $6,000, only a meager 1% falls into this category. This represents a stark difference from the way NFTs began. Now, the NFT industry is shifting its focus toward NFTs that possess intrinsic value. The days of hype have long passed, and the gold rush has ended. The NFT market is making it clear: offer utility or watch your project fail. People are no longer interested in simply collecting NFTs for their artistic value. They expect something in return. A recent instance involved a well-known NFT called Azuki, which launched a new project called Azuki Elementals. Despite a promising announcement video and initial minting activity, it became apparent that Azuki Elementals were merely duplicates of the original Azuki project. If these projects don't evolve to offer real-life utility, they may lose most of their value. Now, are NFTs dead? Far from it. Free mints like SugarTown and Cart Party have performed well recently, with investors gaining significant profits without risking a mint fee. However, the future of NFTs depends on the utility they can provide. Areas where NFTs can offer utility include cultural heritage, gaming, gated access, fractional ownership, real estate, digital identity, and much more. If NFTs evolve to offer utilities like these, who knows? We may yet see a boom in the NFT world again.